Do you know how much 10,000 yuan is worth now compared to past decades? You probably can't guess. According to data from the central bank, the value of money is depreciating. It's hard to imagine to what extent. Currently, 10,000 yuan is equivalent to 5,500 yuan in 2012, 2,700 yuan in 2008, 620 yuan in 1998. 63 yuan in 1988, and 7 yuan in 1978. It shocks you, right? Now think about it. A motorcycle now costs 70 to 80,000 yuan.
In our lifetime, we will definitely see a Chinese fried donut stick costing 8 to 9 yuan and a bowl of beef noodle soup costing 89 to 90 yuan. In the current society, wealth is depreciating, and labor is also starting to devalue. Between 1985 and 2020, over these 35 years, the currency has evaporated at an average rate of 15% per year. This means that this year's 100 yuan will have a purchasing power equivalent to 85 yuan next year. Last year, the entire year's newly issued currency was only 28 trillion yuan, but this year, in just the first quarter, the evaporated currency is around 15 trillion yuan. So, think about it slowly. In our lifetime, you will definitely see a donut stick for 8 to 9 yuan and a bowl of beef noodle soup for 89.90 yuan.
Behind the sharp devaluation of the Chinese currency is a large number of factory closures and massive unemployment, signaling an unprecedented economic downturn in China.
The downturn of physical stores in China is a pain point for the current economic development. Whether it's shopping malls or small retail stores, they are all facing a recession. At 6:30, there's not a single table occupied, just 2 private rooms. Where did all the customers go? Look, there's no one here. Closed? It's closed. Today is Saturday, and there's no one in the restaurant. The once lively and extraordinary catering industry now sees very few customers. This owner can't spot a single customer in the entire restaurant.
Let's take a look at the market situation. There are no buyers, only sellers and owners. Look, it's empty.
With the decline in the Chinese economy, the manufacturing industry, especially large factories, is the first to be impacted, making it difficult for even big factories to survive this winter. Not to mention the small factories. As various raw material costs continue to rise, many factories have seen a sharp decline in business. Many small and medium-sized factory owners cannot withstand this impact and end up closing. Here's another place who went out of business. This place used to be an injection molding factory. Now the machines have all been sold. This row consists of cars owned by various supplier bosses waiting to come and collect money. The manufacturing industry is too challenging. These are all vehicles that couldn't afford the monthly installment and were dragged back by the financial company. The parking lot is full. Driving such a big truck for transportation, they can't even afford the monthly rent. In the past, the freight industry had truck drivers busy delivering goods, one after another, with decent freight rates. But now, there are very few shipments. Combined with various changes in policies, the current freight market is extremely bleak. In a scenario with no fairness and no bottom line, sellers and platforms are suppressing prices. In previous years, things might have been better, but nowadays, looking at the costs of loading, unloading, and high penalties, coupled with the industry's low point, it is very difficult to survive in this industry. Another person from the same industry has closed down and fled, leaving unpaid wages of 3,000 to 4,000 to the workers. For these people who work with their hands, they can't receive their payments. The reputation of the processing factory is tarnished by individuals like this.
With China's economic decline, a wave of closures, and a surge in unemployment, the continuous depreciation of the Chinese yuan against the US dollar has attracted widespread attention. On January 16th, the onshore opening rate for the Chinese yuan was 7.179, closing at 7.184 against the US dollar, a decline of 117 points. hitting a new low since November 17, 2023. The offshore opening rate was 7.184, reaching the 7.2 to 1 US dollar threshold, with an intraday decline of over 300 points, closing at 7.21, setting a new low since November 20, 2023. Authorized by the People's Bank of China, the China Foreign Exchange Trading Center announced that on January 16, the central parity rate of the yuan against the US dollar in the interbank foreign exchange market was 7.113, a decrease of 50 basis points from the previous trading day's rate of 7.108. This marks the lowest depreciation of the yuan central parity since December 23, 2023. Traders have noted that the market is continually playing games in response to the pace of interest rate cuts by the Federal Reserve. With the rebound of the US dollar and concerns about China's economic performance from the previous quarter and the last year, the Chinese yuan is under pressure. In 2023, the depreciation of the Chinese yuan against the US dollar exceeded 3%, making it one of the worst performing currencies in Asia. The onshore yuan to USD exchange rate has repeatedly fallen below 7.2. According to Bloomberg, despite the measures taken by the Chinese authorities to stabilize the yuan exchange rate, Wall Street still believes that the yuan has significant room for further depreciation. Analysts from JP Morgan wrote in a research report that the trend of the yuan further softening is still evident, and the upward trend of the US dollar against the yuan is persistent. The Japan Economic News recently reported that the Japan Economic Research Center released an economic outlook report discussing the future of the Chinese economy. Assuming that China's financial crisis erupts in 2027, the report suggests that the Chinese Communist government will prioritize debt repayment, reduce infrastructure, and the yuan to USD exchange rate will depreciate to around 9:1. China's economy will fall into a low growth of around 1%, affecting the economic growth of 17 other countries and regions. However, some Chinese experts and scholars believe that the assessment by Japanese scholars may be too optimistic. Frank Scher, a professor at the School of Business at the University of South Carolina, Aiken, believes that China's current total debt is estimated to be 3 times the GDP. With the added issue of a real estate bubble burst, the crisis will only become more significant. Although the Chinese Communist Party has used various methods to rescue the housing market, even allowing university students and retirees to buy houses, it has not shown any signs of improvement. Further decline without income from land sales will reduce income at all levels of government. How will the Chinese Communist Party repay its debts? It can print money, and the yuan may eventually devalue to 1:20, or even 1:30, shrinking the wealth of the Chinese people. Chen Xiaonong, a scholar of China's politics and economy based in the United States, suggests that official Chinese economic data deviates from reality, preventing foreign scholars from seeing the most real and underlying problems of the Chinese economy. Problems arising from real estate and debt defaults will affect political stability. The Chinese government will not provide data to the outside world, nor will it admit to the bursting of the real estate bubble. Chen says that for the Chinese Communist Party, the entire financial system is state-owned banks, and if it collapses, it means a collapse of the regime. The authorities will not admit to it. They will tough it out and not repay debts. Even the people's deposits will not be allowed to be withdrawn. They will persist until they can't anymore. In such a situation, you cannot predict what a normal economic situation is. Chen states that this financial crisis China faces is different from 1996. In the past, state-owned enterprises could be closed, and there was an opportunity to join the World Trade Organization, helping China's economy slowly recover. But now, the CCP treats banks as a government's cashier, concentrating all local debts in banks, causing funds to circulate faster and get locked up. Chen warns that a banking collapse will plunge the Chinese economy into an endless danger. The Chinese economy is experiencing a decline, with capital in yuan-denominated bonds and stock markets continuously flowing out. While foreign capital is also massively withdrawing, it has triggered a rapid depreciation of the Chinese yuan. According to data released by the Chinese Ministry of Commerce on December 21st, 2023, the actual utilization of foreign capital by the CCP in November amounted to 53.3 billion yuan, approximately 7.5 billion USD, a decrease of 19.5% compared to the same period last year, reaching the lowest level since the outbreak of the pandemic in February 2020. A September 2023 report by JP Morgan revealed that half of the 250 to 300 billion in foreign bond investments since 2019 have been withdrawn. Private equity and venture capital investments by the United States and China have decreased by over 50%. Data shows that the net outflow of funds reached 53.9 billion in September 2023, marking the largest outflow since January 2016, when capital outflow was 55.8 billion due to factors such as yuan depreciation. Significant capital outflows are evident in sectors directly related to direct investment, such as factory construction, totaling 26.2 billion. Net outflows related to security investments, including stocks and bonds, were 14.6 billion, trending in a net outflow pattern since February 2022. In August 2023, China experienced a capital outflow of 49 billion, the largest since December 2015. The outflow of funds also caused the yuan exchange rate to fall to its lowest point in 16 years. Data published by the CCP's Foreign Exchange Regulatory Agency shows that in July 2023, the amount of bonds held by foreign institutional investors decreased by 37 billion yuan to 324 million yuan. Official CCP data indicates that foreign direct investment in China hit a 25-year low in the second quarter of 2023, falling to 4.9 billion, a year-on-year decrease of 87%. Jiun Cho, a professor of economics at National Central University in Taiwan, states that there are many reasons for the depreciation of the yuan. The yuan is typically supported by a good trade surplus, but now they are not making money from exports, leading to a lack of demand for exchanging yuan. Cho explains that the withdrawal of foreign capital will convert yuan into US dollars, causing the yuan to be very weak. On the other hand, there is a confidence issue. China's economic outlook seems very bleak, and it should be reversed. Foreign capital withdrawal is causing the depreciation of the yuan, not the other way around. Economist Yu Wei-sheng suggests that the scale of foreign capital withdrawal in 2023 will be much larger than in 2022. Wise people should be able to see that China has many problems economically, and those who can leave should do so quickly. The trend of yuan depreciation is likely to deepen, with some suggesting it may reach 7.5 or even 8, as China's economic problems are significant. A recent media article claimed that China's wealthy have transferred hundreds of billions of dollars abroad this year, buying overseas real estate, large amounts of foreign currency, or gold bars. Zhao Zhe, CEO of Tokyo online real estate service provider Ohiago, stated that Chinese people have become the main buyers of apartments in Tokyo priced at 3 million or more, often paying in cash. Meng Jun, a Chinese entrepreneur living in the United States, stated that the CCP is now blatantly robbing the wealthy because the CCP is out of money. The CCP has now reached a point of open looting, and the rich are in danger. So wealthy individuals need to quickly sell off their assets and move away. On December 5th, 2023, Moody's, one of the three major international rating agencies, released a new report stating that China's credit rating outlook has been downgraded from stable to negative. Moody's reason includes slowing economic growth, accumulating risk of local government debt, and the impact of the downturn in real estate on local finances. In addition, the CCP's National Finance and Development Laboratory second quarter 2023 report on the yuan exchange admits that the yuan experienced 3 waves of depreciation in February 2022, February 2023, and May to July 2023. The first 2 waves of depreciation were mainly due to external factors related to the US dollar index, the US-China interest rate differential, and capital flows. However, the third wave of depreciation from May to July 2023 saw a significant reduction in the correlation between the yuan exchange rate and the aforementioned variables. The dominant factor in the depreciation of the yuan against the US dollar was internal, related to the slowdown in China's economic growth. David Huang, a US economist, stated that the reason for the sharp depreciation of the yuan in early 2023 was because the yuan was to internationalize, similar to the large amount of yuan held by countries like Argentina, Brazil, and Russia being thrown into the market to exchange for US dollars, leading to a sharp drop in the yuan. As for the significant depreciation of the yuan in August 2023, it is more related to China's domestic financial situation and financial crisis, including issues with the companies like Evergrande and Country Garden, as well as the difficulties in China's economy. Economist William Yu from the UCLA Anderson Forecast Center analyzes that the CCP has consistently aimed to challenge the world's hegemony of the US dollar. They seek to expand the influence of the Chinese yuan globally, including in countries like Saudi Arabia and South America. In the process, the so-called offshore yuan market booms larger, making it difficult to control. It is like trying to make a horse run fast but not eat grass. An impossible task. When this situation occurs, the offshore yuan will experience significant fluctuations, making control challenging. In the face of the rapid depreciation of the yuan, the People's Bank of China is becoming increasingly uneasy. According to sources cited by Reuters, major state-owned banks in China are actively selling US dollars and buying yuan, both domestically and offshore, in an attempt to slow down the devaluation of the yuan. The depreciation of the Chinese yuan is causing a significant impact on the Chinese people, with the onslaught of business closures and rising unemployment. On December 31st, 2023, Guangdong Dongguan Zhongxin Electronics, an iconic factory under the Zhongxin Electric Appliances Group that had been operating for nearly 30 years, announced its complete closure. The reason cited was a sharp decline in factory orders, long-term financial deficits, making it difficult to continue operations. Zhongxin Electronics was a large processing-oriented enterprise invested by Japan's Star Electric Co. Limited in Dongguan, with thousands of employees. Ms. Shen, the manager of a restaurant in Hojie, Dongguan, mentioned on November 29, 2023, to Radio Free Asia that due to numerous factory closures and workers leaving, even the catering industry was severely affected, leading to the closure of many restaurants. She mentioned that this situation is prevalent in many places, not limited to specific districts, cities, or provinces. Over the past 3 years, due to the pandemic, no one has been able to cope effectively. Recent reports in mainland Chinese media state that both physical store owners and business owners are finding it increasingly challenging to make money, and conducting business is becoming more difficult. The article reveals that in 2021, over 10 million physical stores closed, and the situation worsened in 2022, with 40,000 physical stores closing every day. In the first half of 2023, at least 4,181 physical stores failed to enter the second half of the year. Moreover, China's manufacturing industry has been sluggish for most of 2023. With foreign enterprises shifting production to countries with lower factory production costs, resulting in a significant loss of foreign trade orders to countries like Vietnam and India. Companies like Nike, Adidas, Samsung, and Qualcomm moved away from China, followed by Canon and Apple relocating production lines to Vietnam. China's manufacturing industry is facing an unprecedented wave of shutdowns. A report released by the Japan Chambers of Commerce in China on January 15, 2024, revealed that most Japanese companies in China are not optimistic about China's economic prospects for 2024. Additionally, most Japanese companies reduced or did not invest in China last year. According to Bloomberg, a Japanese Chamber of Commerce official stated after the reports released that this is likely due to the challenges faced by the automotive industry. Foreign car companies, including Japanese automakers, are increasingly struggling in China's competitive market. Mitsubishi Motors announced its withdrawal from the Chinese market last year. The report once again indicates a significant decrease in the optimism of foreign companies regarding China's economic prospects. China's economy is plagued by a series of problems, including a real estate crisis, historically high youth unemployment rates, persistently low consumerism, and increased financial pressures on local governments. According to reports by Chinese media TMT Post, in 2023, China had 10,900 chip-related enterprises that were deregistered or revoked, an increase of nearly 90% compared to 2022. This means that on average, 31 chip companies disappeared every day in 2023. Nearly 7,000 rural homestay closed down in the first 11 months of 2023. And there has been a wave of closures in the catering and clothing industries. Behind these alarming closure figures are the changed destinies of countless migrant workers. China's National Bureau of Statistics released economic data on December 15, 2023, indicating that in November 2023, the unemployment rate for local registered urban labor was 5.1%, while for non-local registered labor, it was 4.7%. The urban unemployment rate in 31 major cities was 5%. The Bureau no longer publishes the youth unemployment rate, with the most recent data in June 2023 soaring to 21.3%, a historic record. The actual situation is suggested to be worse. In addition, on December 5th, the Chinese Ministry of Education announced that there would be 11.79 million college students graduating in 2024, an increase of 210,000 from 2023, reaching a new high. Analysts believe that when the graduates of 2024 enter the job market after graduating from university, they will face even greater employment pressure, leading to a further increase in the unemployment rate. An analysis article in the Wall Street Journal on December 5th, 2023 pointed out that the Chinese economy is caught in a vicious cycle. Without restoring the labor market and consumer confidence, China is likely unable to revive the vitality of the domestic real estate market. However, improving consumer confidence and boosting the labor market is challenging, and unless the Beijing authorities can find a solution to this problem, the recovery of the Chinese economies is expected to be rocky.